$600 billion collapse. Lehman Brothers. In 2008, Lehman Brothers collapsed with more than $600 billion tied to its failure. It had survived wars, recessions, and market crashes. It had existed for more than 150 years. And then, almost overnight, it was gone. How does a Wall Street giant that old, that powerful, and that connected suddenly collapse? Was it just bad luck? Was it the housing market? Or was the system already rotting long before the final crash? Because Lehman did not fail in a single moment. It failed slowly, then all at once. And when it went down, the damage did not stop at one company. It helped turn fear into panic, and panic into a global financial disaster. This is the collapse of Lehman Brothers. Lehman Brothers started as a small business in the 1800s. Over time, it transformed into one of the most powerful investment banks in the world. By the 2000s, Lehman was deeply tied to Wall Street, global finance, and the machinery of modern banking. It was not some weak company hanging on by a thread. It looked serious, established, important. That appearance mattered, because in finance, confidence is oxygen. As long as people believe you are strong, money keeps moving, deals keep happening, credit keeps flowing, and the machine keeps running. Lehman understood that world. It lived inside that world. And for years, it made enormous bets that seemed smart while markets were rising. The core of the problem was housing. During the housing boom, banks and financial institutions poured money into mortgages and mortgage-related securities. The logic seemed simple. Housing prices kept rising. People kept borrowing. Loans kept getting bundled, sold, and repackaged into complex financial products. As long as home prices rose, the system looked brilliant. There were fees, there were profits, there was growth, and there was plenty of money to be made. Lehman wanted more of it, so it built up major exposure to real estate and mortgage-backed assets. It did not just touch the housing market. It leaned into it, hard. That is where the danger began. Because when a company becomes too concentrated in one fragile area, it stops being flexible. It becomes dependent. And dependency becomes fatal when conditions change. Lehman kept piling into risky real estate-related positions. It borrowed heavily. It used leverage. That means it used borrowed money to increase the size of its bets. Leverage can make returns look amazing on the way up. But on the way down, it turns losses into disasters. That is what made Lehman so dangerous. It was not just exposed, it was amplified. Every crack in the market hit harder because the company had built itself on borrowed confidence. And while the public still saw a prestigious Wall Street firm, underneath the surface, risk was growing. The problem with bubbles is that they reward the wrong behavior for a long time. When prices keep going up, people feel smart. When profits keep showing up, warning signs get ignored. When everyone is making money, caution feels foolish. So instead of backing away, firms often go deeper. That is what happened here. The housing boom made aggressive behavior look rational. Short-term wins disguised long-term danger. And Lehman was not alone. Many firms were swimming in the same water. But Lehman became one of the clearest symbols of what happens when a system confuses rising prices with real strength. Eventually, the housing market began to crack. Mortgage defaults rose. The securities tied to those mortgages started losing value. And once that started, the damage spread. Because these were not simple assets sitting quietly on a balance sheet. They were tied into broader funding markets, investor trust, and the entire perception of financial stability. Now, the same leverage that made gains look bigger was making losses far more painful. And this is where the psychology of collapse gets important. A collapse is not just math, it is trust. Once investors, lenders, and counterparties begin to doubt you, everything changes. Questions start spreading. How much risk are you really holding? How bad are the losses? What else is being hidden? Can you survive? And once enough people ask those questions at the same time, a dangerous cycle begins. Confidence falls. Funding gets tighter. Fear rises. And every rumor becomes a threat. Lehman entered exactly that spiral. The firm tried to project stability. It tried to reassure markets. It tried to convince the world that it could manage the damage. But the market was no longer in a generous mood. When trust disappears, explanations stop working. And in a crisis, perception can kill you before the final numbers do. Lehman needed confidence. Instead, it got suspicion. It needed liquidity. Instead, funding pressure grew. It needed time. Instead, the clock sped up. One of the most dangerous truths in finance is that a firm can look alive right up until the moment it fails. From the outside, the suit still looks pressed. The name still carries prestige. The logo still shines. But the funding model underneath is breaking. The collapse may already be in motion. That was Lehman, a giant with a weakening foundation. And the deeper problem was not just bad assets. It was dependence on short-term confidence in a market that had started to panic. This is what makes financial collapses so terrifying. A normal business might fail over time. Sales weaken. Costs rise. Losses build slowly. But in high finance, once trust cracks, the speed becomes violent. Counterparties pull back. Lenders hesitate. Liquidity dries up. And a firm can go from troubled to dead in a very short window. Lehman tried to survive. There were efforts to find solutions. There were talks, negotiations, and pressure. People hoped a rescue would emerge. Because by this point, Lehman was not just another bank. Its failure would signal something much bigger. It would tell the world that even a major Wall Street institution could be allowed to collapse. And that message was explosive. In September 2008, Lehman Brothers filed for bankruptcy. That bankruptcy became one of the largest in U.S. history. And the effect was immediate. Shock spread across the markets. Investors panicked. Credit markets tightened. Fear intensified. This was no longer just about Lehman. It became about the entire financial system. If Lehman could fail, who was next? Which balance sheets were real? Which firms were exposed? Who could be trusted? That uncertainty was poison. Because financial systems do not run on money alone. They run on belief. Belief that loans will be repaid. Belief that counterparties are solvent. Belief that institutions are stable enough for tomorrow. When that belief collapses, the machinery seizes. That is why Lehman mattered so much. Its bankruptcy did not just destroy one institution. It shattered confidence during an already fragile moment. And once confidence broke, the panic spread far beyond Wall Street. Businesses faced tighter credit. Markets convulsed. Jobs disappeared. Retirement accounts were damaged. Families felt the consequences of decisions they never made. That is one of the brutal truths of corporate collapse. The people taking the risk are often not the people who suffer the most. The pain moves outward. Employees, investors, workers, ordinary households. The entire economy can end up paying for executive decisions, flawed incentives, and years of tolerated fragility. And that is exactly why Lehman remains such an important case study. Because this was not merely a story about one reckless bank. It was a story about leverage, incentives, illusion, and systemic vulnerability. It showed how a firm can look powerful while becoming increasingly fragile. It showed how short-term profits can hide long-term danger. And it showed how dependence on confidence can become fatal when confidence disappears. There is also a human lesson here. During bubbles, people often assume the big names are safe. They assume prestige means discipline. They assume size means protection. But history keeps proving the same lesson. Big does not mean safe. Old does not mean wise. Famous does not mean stable. Sometimes the institutions that look most permanent are the ones carrying the most hidden risk. That is part of what made Lehman so psychologically shocking. It was not supposed to happen to a firm like that. Not a 158-year-old institution. Not a name that deeply embedded in the system. Not a company with that much history. And yet it happened. Because history cannot protect a bad structure. Prestige cannot fix overexposure. And confidence cannot survive forever if the foundation underneath is failing. There is another reason this collapse still matters today. Modern systems are still vulnerable to the same human weaknesses. Greed, short-term thinking, overconfidence, the temptation to stretch risk during good times, the belief that someone else will step in if things get bad. Those patterns never fully disappear. They change shape. They wear new clothes. They use new language. But the underlying psychology remains familiar. That is why studying collapse matters. Because collapse leaves clues. It teaches pattern recognition. It shows what happens when incentives drift too far from discipline. It shows what happens when complexity hides danger instead of managing it. And it reminds us that systems often break gradually before they break publicly. By the time the public sees the explosion, the real damage may have been building for years. Lehman Brothers became one of the defining symbols of the 2008 financial crisis, not because it was the only problem, and not because it acted alone, but because its failure concentrated the fear of the era into one terrifying moment. A giant had fallen. And if that giant could fall, maybe the whole structure was weaker than anyone wanted to admit. That fear was justified. The world that followed was filled with recession, unemployment, destroyed wealth, and lasting distrust. And Lehman became a permanent warning. A warning about leverage. A warning about housing bubbles. A warning about financial engineering without enough restraint. And a warning about what happens when a system depends too much on confidence and not enough on real durability. In the end, Lehman Brothers did not collapse because one bad day suddenly appeared out of nowhere. It collapsed because risk had been building inside a fragile structure for too long. The housing boom hid it. Leverage magnified it. Confidence delayed the reckoning. And panic finished the job. That is what made the collapse so devastating. And that is why the story still matters. Because the biggest failures in business often do not begin with disaster. They begin with success that no one questions. And that may be the most dangerous moment of all. If you want more breakdowns like this, subscribe. Because some companies do not just fail. They expose the fault lines underneath the entire system.